SIP, or the Systematic Investment Plan, is a popular word in investing. In numbers, there are presently 4.3 crore SIP accounts, but remarkably, what took the industry 25 years to achieve was then replicated over these last 3 years as millions of Indians found favor with the financial markets. In fact, this last month, about 10,000 crores of money was brought in via the SIP route, and it's the kind of money that adds a lot of buoyancy to the domestic stock markets. In this video, we shall look at some important aspects of this quintessential investing tool, and more importantly, we'll answer many of the commonly asked questions we often receive on this topic. This video might be a bit longer than our other videos, so feel free to use YouTube's chapter function to skip to the part that interests you the most. Let's begin. An SIP is not an asset class like equities, bonds, real estate, or gold. SIPs are also not a financial product like mutual funds, shares, fixed deposits, etc. Quite simply, an SIP is an investing technique that requires you to automatically invest a fixed sum of money at pre-specified time intervals. Now notice here that this definition does not refer to any asset class or financial product. And that's because the SIP investing technique can be applied universally across mutual funds, ETFs, your public provident fund, fixed deposits, and even if you are buying a 2-gram gold coin every month. What's important here are those 3 words or phrases, that is, an SIP should be automatic, it requires a fixed sum of money to be invested, and the investment is done at a preset time frequency like say the 1st, 5th or 10th of every month. Let's understand how an SIP works in a mutual fund environment. Now when setting an SIP, an investor needs to decide on 4 things. First, which fund, which scheme to invest into. Next, the amount you want to invest. Thirdly, the frequency of payments, that is weekly, monthly, quarterly, etc. And finally, the day on which that amount is to be deducted from your bank account. So very quickly, say we are sitting in March of this year and I want to set up my SIP to start from the 1st of April. Plus, I want to invest 10,000 rupees on the first business day of every month, and I want this money to go to a mid-cap fund, say the Nippon India Growth Fund. Now, per this construct, a sum of 10,000 rupees shall be deducted from my bank account on the first working day of each month, and correspondingly, I shall be allotted units in the Nippon India Growth Fund at the prevailing NAV on that day. And that's how this process continues until you choose to terminate or put an end to your SIP. Now, do notice in this table that the number of units allotted are a function of the scheme's NAV on that date. So if the scheme's NAV increases, the investor is allotted a lower number of units and vice versa, and that's pretty much how the SIP mechanism works. Over time, the investor continues to accumulate units, sometimes more if there is a sharp correction, and sometimes less if there is a sudden rally. And it's this less and more accumulation that helps averaging the cost of acquiring the mutual fund units over the entire SIP portfolio. This disciplined technique of investing is today counted among the best wealth building tools for everyday investors, and here's why. SIPs often match our income cycle, and some part of the monthly salary can be apportioned towards investing. SIPs are automatic, which makes it the perfect antidote to the problem of people investing when markets are high and withdrawing money when the markets are low. SIPs are flexible, they help us do small accumulations and offer compounding advantages. And finally, the averaging function ensures that one doesn't need to worry about when to enter and exit the market, which is somewhat of a massive advantage for any regular investor. To better understand SIP returns, we looked at how SIPs done on different Nifty indices had performed over many years. For this study, we examined SIPs in the Nifty 50, the Nifty Mid Cap 150, and the Nifty Small Cap 250. More specifically, we settled for 10-year SIPs, and this made a lot of sense to us as it not only captures a couple of bull markets, but it also consumes much of the volatility and complexity we have seen with the global financial crisis of 2008, the European debt crisis in 2011, demonetization in 2016, and of course the coronavirus pandemic in 2020. The study shows that these 10-year SIPs in all three indices have delivered an annualized return of 20% or more over some points of time with a median performance of about 13%. Further, there has not been a single negative 10-year return period, with 2.8% being the lowest recorded annualized return for an SIP on the small cap 250, which happened between March 2010 and March of 2020. Now 2.8% to 23.3% is quite a range, and while the median does an effective job, we also wanted to get a probabilistic estimate of returns, which is why we also looked at the 10-year SIP rolling returns for different performance slabs for all three indices. The data here shows that SIPs have delivered between 8% to 20% returns on over 85% occasions. In fact, you might find it rather strange that a 10-year SIP in the Nifty Midcap 150 has delivered over 8% returns on 99.4% occasions, which is certainly a remarkable stat. Now, time is a big factor in investing, and it is often said that the longer your investment horizon, the more consistent and less volatile will be your returns. In that context, we put this to the test in the SIP environment by comparing the 10-year rolling returns with the 5-year rolling returns. The negative observations are just a few for the large and the mid-cap index, but a lot more for the Nifty small cap index. Likewise, one can see a lot more spread in the 5-year data, which means one can receive a lot more returns or a lot less based on the timing of the returns. Net, it is highly advised to keep your SIPs going for longer periods of time, as it gives you a lot more predictability and a much higher probability of making adequate returns on your investments. In this section of the video, we shall answer or at least state an opinion on some of the most commonly asked questions regarding SIPs. Let's start with a question that I'm sure would have crossed your mind at some point of time. How much should I invest in a mutual fund SIP? Well, the answer to this depends on 4 variables, which are the targeted amount, how much can you comfortably invest every month, the time horizon of investment, and lastly, the expected returns. In fact, if you know the money you can dedicate and the number of years, here's a quick table that one can refer to as a part of your wealth planning process. So say you want to accumulate for your child's higher studies and you are targeting a corpus of 1 crore 15 years from now. In that case, per this table and assuming an annual return of 12%, a monthly SIP of 20,000 rupees should do the job. Now, if you want to do more permutations and combinations on this, like making changes to the expected returns or changing the amount, then do check out the SIP calculator on ETMONEY.com. Okay, so let's move on to question number 2, which is on how to invest via SIPs. Let's address this question from 2 angles. Firstly, the platform that one can use, and secondly, the type of plan that one should invest into. In terms of platform, there are many options. One can invest offline through an agent or walk into a bank branch, and there will always be someone who's more than happy to help you with setting up your investments. The more popular option now is the digital mode, where one can invest via the mutual fund company website, through bank websites, and of course invest via a growing number of investing platforms like ETMONEY. Now, a platform like ETMONEY comes with many advantages. For one, our platform allows users to research and invest in over 1,000 mutual fund schemes, and one does not need to log on to 10 different AMC websites to do that. Secondly, our carefully crafted user experience and workflow makes it a lot easier to invest, manage, and track your investments. And most importantly, the ETMONEY platform allows and encourages you to buy direct plans. To put it briefly, direct plans are basically a variant of existing mutual fund schemes that come with zero commission. This means the portfolio, the investing style, the fund manager, all of this remains the same as the regular variant, barring one key difference, that is, these direct plans have a lower expense ratio, which translates to a higher return for the investor. In fact, to put it in numbers, let's see what happens when we invest a monthly SIP of 10,000 rupees over 20 years in the regular and direct plans of an equity mutual fund. Now, assuming that the regular plan gives a 12% return, it would be fair to assume that a direct plan would deliver 75 basis points higher, so that's an assumed return of 12.75%. At 12%, our regular plan SIP would accumulate 99.9 lakhs over 20 years, and at 12.75%, the direct plan corpus would be a higher number, which in this case comes to 1.11 crores. This comes to a difference of 12 lakh rupees between the direct and the regular plans. And if you're wondering where this 12 lakh rupees goes, this is the money that goes to the bank or the agent who pitched the regular plan to you as his or her commission. So figure this, the bank or agent who simply suggested a mutual fund SIP 20 years back made 12 lakh rupees as commission. Now, I'm sure you'll agree that this is a bit too much, so while it's okay to work with a financial advisor for more tactical advice like short-term investing, asset allocation, rebalancing, etc., however, when it comes to long-term goals, you might be better off using direct plans rather than regular plans. Okay, so this was a long answer, but good we talked about it. So let's speed it up a bit and move on to question number 3, which is, in which fund should I start my SIP? Now, this can be a difficult decision, or might I say a confusing decision for many investors. To help out with this, the ETMONEY app has a section titled Best SIP Funds, in which we have listed the more promising actively managed funds. So have a look at that, and before you invest in any of those funds, feel free to check out some additional specifics like the scheme's historical performance, the scheme's return potential, its downside volatility, and also the scheme's ETMONEY category rank. Okay, next we have question number 4, which is a very commonly inquired one. SIP or lump sum, which one is better? Well, the answer to this question is not a straightforward one. There is certainly some place for opinions here, but nevertheless, investors also have to consider many other things like the income one generates, their financial goals, risk profile, etc. before making any kind of judgment. From a pure performance standpoint, let's look at some data. We go back to the Nippon India Growth Fund, and our team studied the SIP and lump sum performance of this scheme over different time periods. Notice here that there are some time brackets where an investment in the lump sum mode delivers better returns, and then there are other times when it's the SIP approach that yields better returns. The general observation is that lump sum investments do better when there has been a quick rally in the stock markets, like what we saw in 2014, 2017, and again in 2021. But that's just 3 big rallies in the last 10 years. So with lump sum investing, the timing of it is of prime importance, which is certainly not the case with SIPs. So is SIP better or is lump sum better? It's a question whose answer might be more to do with your perception rather than taking a hard look at the numbers. So do keep that in mind. The next question, question 5, is on which date is best to start an SIP. So you've done some quick data study on this, and it comes out that SIPs done in the last week of the month give a higher return. But if this information is going to concern you, then wait up, because the data we looked at also revealed that the difference in returns is in the smallest of decimals. I mean, the difference was very insignificant. In fact, what is more significant when deciding on the right SIP dates is to look at one's convenience. For example, if your salary account gets credited on the last day of the month, then an SIP deduction on the first of the month would be ideal for most people. However, if your situation is like mine and you need to transfer your salary from one bank account to another bank account, you might want to keep your debits for a little later, like the 3rd, 5th, or the 7th of the month, so that you don't accidentally miss out on transferring the money. So look at your own conveniences and try not to complicate matters. In fact, speaking of complication, you might have come across daily or weekly SIPs. Again, it's your choice on how you want your investing cycle to be, But having tried these approaches myself, I've always found that the monthly frequency to be the most manageable one in terms of the number of transactions, and most importantly because it coincides with my income cycle, which is also on a monthly basis. The next question is when to exit an SIP. Now, the general advice is to keep SIPs running for many years, and there are many advantages of keeping that engine running. However, just like an engine needs checkups and maintenances, every investment too needs to be reviewed either on a periodic basis or if a significant event has occurred. In our opinion, there are 4 scenarios where exiting an SIP or at least pausing an SIP needs to be considered. 1, if there is extreme market euphoria. Secondly, if one is approaching his or her financial goal. The third scenario is when one needs to sell a part of their portfolio as a part of a rebalancing exercise. And finally, if the fund dynamics have changed, like a change in the objectives, fund manager, etc. For more details on each of these scenarios, do watch a video we have on this on the ETMONEY YouTube channel. I'm sure you'll find it very useful. In a similar thread, investors also ask us this question on how to stop or pause an SIP. Now, this is a bit more difficult in the offline world, but with a platform like ETMONEY, this is as simple as tapping the cancel SIP or the skip next installment button on the app. Okay, the 7th and the last question in this FAQ series is how is an SIP taxed? Now, taxation can be a tricky subject when it comes to mutual funds. After all, there are short-term and long-term capital gains, different types of funds like equity, debt, international funds, etc. The law requires us to use a first in, first out or FIFO method for tax calculation. And to complicate matters further, there is a grandfathering rule that one needs to be aware of when selling any equity fund units that were purchased prior to the 31st of January 2018. But perhaps the cardinal rule every SIP investors has to know is that each and every SIP installment should be treated as a fresh purchase or investment for the purposes of taxation. What this means is that the date on which you started the entire SIP series has no bearing on the calculation of taxes on the subsequent transactions, and each transaction has to be looked at independently. Let's understand this with an example. Say we start an SIP on the 1st of January 2020 and continue investing on the 1st of every month. Now, this investor redeems 15 units on the 5th of December. Per the FIFO rule, the 15 units sold would be balanced with 10 units that were purchased on the 1st of January and another 5 units from the 1st of February. A simple weighted math will give us the capital gain, which in this case will be short-term in nature as the holding period of those 15 units were less than 1 year. As a result, the short-term capital gain will be calculated at 15% plus cess and surcharge. Likewise, if another redemption was made on the 7th of April 2021, then again the FIFO rules will apply, but more importantly, in this case, the capital gains will be long-term and taxes will be calculated at 10%. Now remember, this 15% for short-term and 10% for long-term is only for equity mutual funds. For other mutual funds like debt funds and also other asset classes like gold, different capital gains rules apply. And if you want a refresher on that, then do watch our video on the same. And with this, we come to the end of this video. A systematic investment plan is an important investing technique to have in anyone's wealth building arsenal. I sincerely hope you found this video useful and will use it to improve your own SIP investing strategy. Once again, thank you for your time. Please like, please subscribe, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.